Sharplink Gaming Inc., NASDAQ SBET, recently experienced a notable surge in options trading activity, with investors acquiring 131,605 call options, marking a 16% increase from the usual daily volume. This heightened interest in call options, which are contracts that give the holder the right to buy a stock at a specified price within a certain time frame, suggests increased speculative interest or potential bullish sentiment surrounding the company's future performance. The unusual trading activity coincides with insider purchases, as CEO Rob Fithian and CFO Robert Michael DeLucia significantly increased their stakes in the company, indicating confidence in its prospects. Despite this insider confidence, Sharplink Gaming's financial performance reflects ongoing challenges. The company reported a loss of $1.73 per share in its latest earnings release, with revenue of only $0.74 million. Furthermore, the company struggles with a negative net margin of 94.08% and a return on equity of -162.25%, highlighting operational inefficiencies and financial distress. The stock's volatile performance, with a 52-week range between $2.26 and $124.12, underscores the uncertainty and high-risk nature of investing in Sharplink Gaming. As the company operates in the competitive online sports betting and iGaming sector, investors should weigh these financial metrics against the potential growth opportunities implied by insider actions and market interest.
Foreign institutional investors, FIIs, have aggressively sold Indian IT stocks, leading to a significant downturn in the market. The Nifty IT index has plummeted by 25% in 2025, making it the worst-performing segment. FIIs have offloaded over 50,000 crore rupees worth of IT stocks, contributing to more than half of the 95,600 crore rupees withdrawn from Indian markets this year. The sell-off accelerated in recent months due to disappointing Q1 earnings and widespread layoffs, particularly impacting major players like Tata Consultancy Services, TCS, which announced 12,000 job cuts. Other IT giants such as Infosys, HCL Technologies, Wipro, and LTIMindtree have also seen substantial stock declines. The weak demand environment, driven by factors like tariff impacts and reduced discretionary spending, has led to underwhelming financial results across the IT sector. Companies have struggled with margin pressures despite implementing cost optimization measures. Analysts at Kotak Securities noted a broad-based revenue decline among large IT firms, while BNP Paribas highlighted a mixed earnings scorecard with a majority missing margin expectations. However, the valuation correction has made the sector more attractive, prompting Jefferies to upgrade it to neutral from underweight, suggesting potential for a near-term tactical bounce. Despite the current challenges, some market veterans see long-term opportunities due to structural advantages like lower operating costs and a skilled workforce.
The recent focus on Metaverse stocks highlights the growing investor interest in companies involved in virtual and augmented reality technologies. Key players such as NVIDIA, Accenture, Globant, SK Telecom, and Robot Consulting are at the forefront, each contributing to different facets of the Metaverse ecosystem. NVIDIA, known for its graphics processing units, GPS, and compute solutions, saw a slight dip in its stock price, trading at $179.32, though it remains near its one-year high of $183.88. The company's financial metrics, including a robust market cap of $4.38 trillion and a P/E ratio of 57.87, underscore its strong position in the tech sector, particularly in gaming and virtual environments. Accenture, a leader in professional services, also experienced a decline, with its stock reaching $240.78. Despite this, Accenture's comprehensive offerings in strategy, consulting, and technology, including its Metaverse and AI solutions, position it well for future growth. With a market cap of $150.81 billion and a P/E ratio of 19.19, Accenture remains a significant player in the digital transformation space. Meanwhile, Globant, another technology service provider, focuses on digital solutions and enterprise technology, with its stock trading at $78.29. The company's expertise in cloud technologies, AI, and the metaverse indicates potential for long-term growth, despite current market fluctuations. Investors are closely watching these companies as they navigate the evolving landscape of digital ecosystems. The Metaverse sector is anticipated to expand significantly, driven by advancements in technology and increasing consumer adoption of virtual experiences. As such, these stocks offer exposure to the potential growth of the digital economy, making them attractive to investors seeking to capitalize on this trend. However, the volatility in stock prices also reflects the inherent risks associated with emerging technologies and market dynamics.
The recent MarketBeat stock screener highlights 7 key healthcare stocks to watch, focusing on companies like Alphabet, United Health Group, Oracle, and Palo Alto Networks. These entities represent a mix of healthcare and technology, reflecting the evolving landscape where tech companies increasingly play a role in healthcare delivery and innovation. Alphabet, for instance, operates through its Google services and Google Cloud segments, which have applications in healthcare data management and analytics. Meanwhile, United Health Group, a traditional healthcare giant, continues to diversify through its Optum segments, providing a broad range of health services and insurance products. The report underscores the defensive nature of healthcare stocks, which are often resilient to economic downturns due to consistent demand driven by aging populations and continuous medical advancements. Notably, Alphabet stock traded at $194.59, with a market capitalization of $2.35 trillion, reflecting its robust position in the market despite a slight dip. United Health Group, trading at $242.22, shows a considerable decrease from its 52-week high, highlighting potential investor concerns or market corrections. Oracle and Palo Alto Networks also saw declines, with Oracle's shares dropping to $246.97, indicating possible volatility in tech-related healthcare investments. These movements suggest a nuanced market environment where investors are balancing the potential growth from tech-driven healthcare innovations against traditional healthcare company stability. The highlighted stock's performance could signal broader market trends, with potential implications for investor strategies focusing on healthcare's intersection with technology. As these companies navigate economic shifts and technological advancements, their ability to adapt and leverage their core strengths will be crucial in maintaining investor confidence and driving long-term growth.
The financial spotlight is currently on Novo Nordisk A/S, Circle Internet Group, and Apollo Global Management as promising growth stocks, as per MarketBeat's stock screener tool. Growth stocks are characterized by their potential to outpace the market in terms of revenue and earnings growth, often reinvesting profits into expansion rather than dividends. Novo Nordisk, a major player in the pharmaceutical sector, saw its shares rise by $3.33 to $48.71, with a significant trading volume of 33.9 million shares, far above its average. The company's focus on diabetes, obesity care, and rare diseases positions it well for sustained growth, with a stable market cap of $217.47 billion and a relatively low beta of 0.63, indicating lower volatility compared to the market. Circle Internet Group, despite its ambitious vision to revolutionize global economic transactions through internet-based systems, faced a decline, with shares dropping $9.23 to $152.48. The company, with a market cap of $33.93 billion, exhibits a strikingly high P/E ratio of -12,049.94, suggesting investor expectations of future profitability despite current losses. Meanwhile, Apollo Global Management, a diversified investment firm, experienced a decrease of $6.07 in its stock price to $139.81, with a market cap of $79.90 billion and a P/E ratio of 26.12. Apollo's focus on varied investment strategies, including private equity and real estate, provides a robust platform for potential long-term growth amidst fluctuating market conditions. These developments highlight the dynamic nature of growth stocks, where investor sentiment and strategic positioning can lead to significant market movements. Each of these entities presents unique opportunities and risks, reflective of broader market trends and individual corporate strategies. Investors should consider these factors when evaluating potential investments in growth stocks, as they navigate the balance between potential high returns and inherent volatility.
Plug Power Inc., NASDAQ Plug, is set to announce its Q2 2025 earnings on August 11th, with analysts forecasting a loss of 15 cents per share and revenue of $157.97 million. This follows the company's previous quarter loss of 21 cents per share, which slightly missed expectations. Plug Power, a key player in hydrogen and fuel cell technology, reported a negative return on equity of 82.21% and a negative net margin of 312.29% in the last quarter, indicating significant challenges in its profitability. The company's stock opened at $1.51, with a market cap of $1.73 billion and a high beta of 2.35, reflecting its volatility. Analysts have mixed views on Plug Power's stock, with 6 recommending a sell, 8 a hold, and 4 a buy, resulting in a consensus hold rating and a target price of $1.92. Notably, Piper Sandler and Wells Fargo have set lower price targets, highlighting cautious sentiment. Despite these challenges, insider activity shows confidence, as evidenced by insider Paul B. Middleton's recent acquisition of 650,000 shares, increasing his stake by over 34%. Institutional investors own 43.48% of the company, with UBS Asset Management recently increasing its holdings by 12.9%, suggesting a mixed but potentially stabilizing outlook for the stock. Plug Power's strategic focus on hydrogen and fuel cell solutions positions it in a growing market, but its financial performance and stock volatility reflect the broader challenges faced by companies in this sector. As the company prepares to release its earnings, stakeholders will be keenly watching for signs of improved financial metrics and strategic initiatives that could enhance its market position and investor confidence.
Floor & Decor Holdings, Inc., NYSE, FND, recently experienced a significant increase in put options trading, with traders acquiring 11,070 put options, marking a 271% rise compared to the usual volume. This surge in options activity suggests heightened bearish sentiment or hedging strategies among investors concerning the company's near-term stock performance. The stock opened at $79.56, slightly down by 0.1%, amidst its 52-week range of $66.01 to $124.68, reflecting market volatility and investor uncertainty. The company's recent quarterly earnings report showed a marginal beat with earnings per share, EPS, of 58 cents against the consensus estimate of 57 cents. Despite a 7.2% year-over-year revenue increase to $1.21 billion, the market remains cautious, as reflected by several analysts downgrading their ratings and lowering price targets. Notably, Goldman Sachs and Loop Capital have set lower target prices, indicating concerns about future growth prospects. The consensus rating for the stock is hold, with an average price target of $88.56. Institutional investors have shown mixed actions, with some increasing their stakes, such as Ontario Teachers Pension Plan Board and SG Americas Securities LLC, while others maintain a cautious stance. The company's financial health, indicated by a quick ratio of 0.28 and a debt-to-equity ratio of 0.08, suggests a stable but cautious outlook. As the market digests these developments, Floor & Decor's strategic positioning and response to evolving market conditions will be critical in shaping its future trajectory.
Grindr Inc., NYSE GRND, has experienced an unusual surge in options trading, with investors purchasing 10,736 put options, marking a 424% increase over the average daily volume. This heightened activity suggests a bearish sentiment among traders, possibly due to the company's recent earnings report, which fell short of analysts' expectations. Grindr reported a quarterly earnings per share EPS of 8 cents, missing the consensus estimate of 10 cents, despite a 26.6% increase in revenue year-over-year to $104 million. The company's negative net margin of 14.41% and a high price-to-earnings ratio of -35.73 reflect ongoing financial challenges. In response to these developments, several analysts have adjusted their ratings and price targets for Grindr. The Goldman Sachs Group raised its price target from $20 to $26, maintaining a buy rating, while Raymond James Financial lowered its target from $26 to $20, still rating it as outperform despite insider selling activities. where directors sold significant shares, Grindr retains a buy consensus rating from analysts with an average price target of $23.40. Institutional investors have shown interest, with notable stakes acquired by firms like Nuveen LLC and Adage Capital Partners, indicating continued confidence in the company's long-term prospects despite short-term volatility.
Grayscale Ethereum Trust, ETH, has witnessed a significant surge in options trading activity, with investors purchasing 11,077 call options, marking a 39% increase over the average volume. This heightened interest comes amid a broader institutional investment trend, as several hedge funds and institutional investors have adjusted their stakes in the trust. Notably, PNC Financial Services Group Inc. increased its position by 86.7% in the second quarter, while other firms like Nawam LLC and Prospera Financial Services Inc. also made substantial new investments. The trust stock has responded positively, trading up 5.0% and opening at $33.59, close to its 52-week high of $34.53. This performance indicates growing investor confidence, possibly driven by broader market optimism surrounding Ethereum and its applications. The increased options activity suggests that investors might be positioning for further upside or hedging against potential volatility. Such movements are particularly relevant for those monitoring cryptocurrency-linked financial products, as they reflect evolving market sentiment and strategic positioning by institutional players.
In a notable development within the options market, traders have significantly increased their acquisition of put options on the Invesco S&P 500 equal weight ETF, NYSEARCARSP, with 16,617 contracts purchased, marking a 99% surge from the average daily volume. Put options give investors the right to sell a security at a predetermined price, often used as a hedge against potential declines in the underlying asset. This spike in put option activity suggests a growing sentiment of caution or anticipation of volatility among market participants regarding the ETF's near-term performance. Institutional investors have been actively adjusting their positions in the Invesco S&P 500 equal weight ETF, with prominent entities like Goldman Sachs significantly increasing their holdings by 219.6% in the first quarter. Such moves indicate a strategic positioning in the ETF, which seeks to replicate the performance of the S&P 500 equal weight index, providing a diversified exposure across major U.S. sectors. Despite the heightened put option activity, the ETF stock showed a modest increase of 0.2%, closing at $183.08, reflecting a stable market perception amidst these strategic shifts. The ETF's market capitalization stands at $73.49 billion, with a P/E ratio of 20.10, and it continues to be a focal point for institutional asset allocation strategies.